Brad Williams, Frugal Finance, understanding initial public offerings. An initial public offering marks a significant transition for a private company as it makes the stock available for public purchase on a stock exchange. This move, commonly referred to as going public, allows a company to generate substantial capital, which can be used for expansion, research, debt repayment, or other corporate purposes. Additionally, early investors, including founders and venture capitalists, may take the opportunity to liquidate their shares for potential profit. The IPO process, going public, involves an extensive preparation phase, during which the company collaborates with investment banks to facilitate the process. These banks, acting as underwriters, assist in structuring the IPO, preparing required regulatory documents, marketing the shares, and setting an offering price. Before trading begins, the company must comply with regulations set by the Securities and Exchange Commission and meet stock exchange listing requirements. Key aspects of an IPO: fundraising opportunity. An IPO allows a company to raise capital through public investment. Regulatory compliance. Companies must adhere to SEC guidelines and stock exchange rules. Investment banking role. Underwriters manage the marketing, pricing, and sale of shares. Liquidity for early investors. Founders and initial investors may sell their shares, realizing returns on their investment. How an IPO works: before an IPO, a company operates as a private entity with a limited number of investors, including founders, family members, and venture capitalists. The transition to a public company provides access to a larger pool of capital and can improve borrowing conditions due to increased financial transparency. Companies often pursue IPOs when they achieve significant growth milestones, sometimes reaching a value of $1 billion or more, commonly known as unicorn status. However, businesses of various sizes may qualify for our IPOs if they demonstrate strong financial and market potential. Underwriters conduct extensive due diligence before pricing IPO shares. When the company goes public, existing private shares convert into publicly traded stock. The early shareholders may either retain or sell their holdings in the market. Meanwhile, public investors ranging from individuals to institutions gain the ability to purchase shares. Historical context of IPOs. IPOs have been a major financial event for centuries. The first modern IPO was conducted by the Dutch East India Company, which offered shares to the public. Since then, companies have utilized IPOs to secure capital from investors. Over time, IPO activity has fluctuated due to economic conditions, industry trends, and market cycles. For example, the dot-com boom saw a surge in technology IPOs, while the 2008 financial crisis led to a sharp decline in new public listings. The IPO process, step by step: selection of underwriters. The company partners with investment banks that oversee the IPO process. Regulatory filings, documentation, including the S-1 registration statement to the SEC. Marketing efforts: a roadshow is conducted to attract investors and engage demand. Pricing strategy: underwriters determine the IPO price based on investor interest, company valuation, and market conditions. Share issuance: on the IPO date, shares are released to the public and the company receives proceeds from the sale. Post-IPO trading: shares begin trading in the open market and company insiders may face restrictions on selling stock during a lockup period. Advantages and challenges of an IPO. Benefits: access to capital for expansion, innovation, and debt repayment. Enhanced public visibility and credibility, which can improve business relationships. The potential for increased employee retention through stock-based compensation. Drawbacks: high costs associated with legal, accounting, and regulatory compliance. Increased scrutiny and pressure from public investors. The potential for market fluctuations impacting share price. Alternatives to IPOs: companies that wish to raise capital without undergoing an IPO may consider direct listing. Shares are made available to the public without underwriters, allowing existing shareholders to sell directly. Dutch auction: investors bid on shares and the final offering price is determined by demand. Private funding: companies may opt for venture capital, private equity, or strategic partnerships instead of going public. Investing in IPOs: IPO investments can be attractive but carry risks. While some IPOs experience significant price increases on their first trading day, others may struggle due to overvaluation or market volatility. Underwriters set the initial share price, often at a discount to stimulate demand. However, retail investors typically gain access to shares only after institutional investors and insiders have had an opportunity to purchase at the offering price. Investors considering IPOs should review the company's prospectus, financial health, and long-term business strategy. Factors such as management expertise, market competition, and industry trends can influence post-IPO performance. IPO performance considerations: lockup period. Company insiders are often restricted from selling shares for a set period, typically 90 to 180 days, to prevent market oversupply. Flipping: some investors purchase IPO shares with the intent to sell them quickly for a short-term profit. Post-IPO volatility: stock prices can experience significant swings in the early months following an IPO. Final thoughts on IPOs? An IPO represents a major milestone for a company, providing access to public capital and increased market visibility. However, going public comes with regulatory responsibility and market risks. For investors, IPOs can present opportunities for substantial returns, but they also require careful evaluation to navigate potential volatility. Whether a company decides to pursue an IPO or explore alternative funding options depends on its financial goals, market conditions, and long-term strategy. If you have any questions or concerns related to initial public offerings, comment. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.